Good morning or afternoon, depending on when you're listening to this webinar. My name is Paul Stout. I'm a corporate finance partner at Francis Clark. This is the corporate finance update as part of the FD 6-monthly seminars. Today, what I really wanted to cover was what we're seeing in the debt markets, talk to you a little bit about transactions and what's happening in terms of deal completions. And then finally, just talk about some of the ideas we've got around transactional management and how to get to a successful deal. So first port of call, the debt markets. I think over the last 18 to 24 months, my debt colleagues have been talking to you about how conservative high street banks become and the rise of the alternative finance market, who have different sources of funding, but are able to structure things in a more flexible way, but are more expensive. Rather than sort of flicking up slides comparing the two, what I thought I'd do is bring a case study to play, which looks at the offers that have been received on a live project. This one's Project Neptune. It was a management buyout in the energy sector. The vendors of the business were outside the business, so the risk in terms from a banking perspective was minimised. We were looking for a 6 million debt term to do the transaction. You can see from this slide that the business was making 3 million EBITDA. The forecasts pushed out to 3.5 million, so they weren't aggressive. It was a good solid banking case. And we went out to market. We had 3 good offers in on this deal. There's a lot of numbers on this page and I'll just walk you through it. So all of the funders were able to deliver the 6 million funding requirement. What we saw in terms of how long they wanted their money paid back, the term, the alternative finance lenders were able to go out to 5 years, whereas the high street bank wanted their money back in 4 years. But really telling the next 2 lines, the amount of the loan that's amortizing versus the amount that's repaid at the end of the 60 months or the 48 months. You can see really clearly there a lot of flexibility in the alternative finance lender, both their structures. In fact, alt finance lender A was happy to have all their money capital repaid at the end of the 5-year period, whereas the banks, they wanted their money paid capital repayments all the way along across that 4-year period. So quite a difference in terms of the flexibility of capital repayments. In terms of the cost of the capital, we'll come back to that 10%. Let's just park that for a while because there's a additional kicker on that one. But you can see what we'd expect and what we've told you before, the alternative financing provider is more expensive. So that's all in cost. That's base rate plus margin. So a good 4%, nearly 4% above where the bank is. And that's what you expect because of the funding sources of the relative lenders. But this is where it really started kicking in terms of the difference now. So the security, alt-fi lenders are happy to take a sort of standard security package, whereas the bank started really trying to want as much security to get their hands on to do this deal. And the conversation moved to personal guarantees. And then the risk profile on some of the covenants, so the debt service coverage ratio, which is really looking at the free cash flow that the business creates and how much of that is surplus. So a lower debt service coverage ratio gives the company more headroom. So on the lend before it breaches a covenant, and the banks can then go in and try and find out what's going in the business. So sort of risk red flag reporting. What you can see is the alt-fi lenders were quite relaxed about their ratios, and that's what we're seeing as a sort of standard ratio. Was the banks have stepped up, they put a much higher ratio in, which meant there was less headroom in trading before the bank would want to step in and find out what's going on in the business. And obviously that would put pressure on the management team. We can see from the annual repayments, clearly because the bank's being asked for the capital to be repaid over 4 years, their repayments are higher. So more stress on the cash flow of the business. I said park the 10%, but the equity fee effectively is where the other alt-fi lender was making their return. So they had a mechanism whereby they got some money when the facility was repaid, they got an uptick. And what that leads to is the total cost of funding, excluding the capital repayments, or the bottom line. So you can see that equity kind of kicker made that the cost of that lend a lot more expensive. the other alt-fi lender 3.6 million, and the high street bank down at 1 million because the interest rate is much lower. Now, on first principles, everybody I think probably listening to this seminar would say, okay, we'll go with the high street bank because that looks the cheapest. But actually, we ended up going with the alt-fi lender B in this example, and the reason for that was that the way the covenants were set and the pressure on the cash flows in terms of the annual repayments were the biggest determining factor. It's a consultancy business, no real assets. It's relying on future trading, could be impacted by the markets. And management were a lot more comfortable paying more cost over time, but having less pressure on their cash flow. So hopefully that just brings to life the fact that it's not all about money. And so coming back to what we would, the kind of slides that we normally flash up, you can see really that high street banks are being conservative and are looking for a lot of security. We're seeing the alt-fi market, alternative finance market, still picking up the slack. The cost of capital is demonstrably higher, but the structures mean that it can be more attractive. So the sort of lesson from that really is, go to a source of funders. The cheapest is not always the best one. Just in terms of interest rates, this is 3 months on your forward-looking rates. It gives you an indication of where the markets think interest rates are going over the next few years. You can see there, 2028, the markets expect them to bottom out around 3.5%. I think latest data coming out of the US over the last couple of days, just in terms of pressure on inflation, will probably impact how quickly interest rate cuts come through in the UK. And so it might be a bit more of a shallower curve, but we still think, or the market still think, that interest rates will come back down to between 3 and 3.5% over the medium term. And lastly, let's not forget about your corporate deposits. Make your money work for you. These interest rates were right 8 days ago when I did the slides. They probably have moved, but you don't have to be particularly creative to get a return on your deposits, so just don't forget about that. So now I just want to walk through what we're seeing in the transaction markets and put some numbers to probably what you're seeing in the press in terms of headwinds in the transactions market. The blue bars are the UK as a whole. The red line is just our region, the PKF Southern region. And what you can see through the years is quite a peak 21, 22. And then for UK, and to be fair, the PKF region maps it almost identically. There's a drop off in deals in 2023, deals being completed. The next slide, what we're looking at is these deals completing by month. And what you can see is definitely the blue being 22, red being 23. You can definitely see that the volumes are lower throughout the year, say for 2 months, but not horrendously low, apart from when you get to October, November, December, where you can see a significant drop off in deal volumes. And what's at play there is we've got some of the headwinds in the economy, some of the uncertainty, the sort of bite of the cost of capital. And we think deals that would normally traditionally be launched maybe September, there was probably a bit of soft trading running up to September, and therefore less deals were getting completed towards the end of the year. So overall, deal volumes remain subdued, and we're expecting them to stay lower than they were in the kind of highs of 21, 22. The underlying market is still strong, so we're still seeing corporates have cash, and there's overseas interest in UK assets. Private equity have still got money to deploy, and there's more demand than there is supply, but we're seeing this cautiousness in the market about doing deals and cautiousness about people launching processes. We're also seeing something which probably we saw during the financial sort of crisis 10, 11, 12, 13, where there is a race to safety and premium assets, which are good defensible assets. And from a pricing perspective, those businesses are still getting the pricing that we would have been getting in 21, 22. We think there's probably a turn or two of pricing coming off for less strong assets. And then coming into 24, there seems to be some market optimism about what the year brings. I don't think we've really seen a massive bounce in activity. The one thing I would say, while that might sound like quite gloomy, for 2023, we again had a record year number of deals, did 100 deals across the PKF network. We just found that there was a cautiousness in terms of timing and diligence. So businesses that are properly prepared, deals are still getting done. And I just want to continue that theme into the next section, which is how do you prepare for a sale and get a good or any transaction and get the right result. And rather, again, I think in previous FD seminars, we've sort of flicked up a list of issues. What I thought I'd do this time to really bring it to life is look at what live transactions and what made them successful versus other transactions which either didn't complete or took longer to complete. So the backdrop really is that deals can take longer. They don't have to take longer, but they can take longer because buyers are more cautious. And the challenge with longer deals, as a sort of time spent conundrum, is that the longer it takes to do a deal, the more time there is for something to go wrong, whether that's an external factor in terms of something happening which is outside the control of the business, or whether it's internal factors. For example, going through diligence, you might miss your budget, and that will be a red flag to a cautious market. And then they might want to see another month and another month. And so time really isn't a friend to you when deals are being stretched out. So what we're saying is preparation is absolutely key. You need to mitigate the deal breakers, and preparation, more than that, gives you the opportunity to get the best value. The other point I would make around deals and expectations is that there needs to be a realistic view on how much cash is going to be received on day one and how much will be structured over time. And that will bridge the buyer and seller expectations in this market. So what we're not saying is that you should accept a deal where you receive most of your cash over time. What we are saying is to get that bridge between where valuations sit today and what you might consider to be a premium valuation, you need to be creative about it. So how does that translate into real deals? So I've sort of split this up by the type of situation that we've encountered. So the sort of classic cold approach, when a business is approached without going onto the market. On the left-hand side is where the deal didn't work so well. On the right-hand side, where it was a bit more successful. So Project M, it was a design agency, sort of niche, high-end, high margins, got approached by a listed competitor who were in adjacent markets and could see the benefit of adding our client to their portfolio. The deal was agreed between the two principals in a meeting in London without advisors. And they decided to kick off. So the process was very much run by the buyer. We got involved. I think the first thing we saw was that the agreement between the parties was very friendly to the buyer. The seller, element of naivety had given away things which, by standard, we wouldn't have accepted. The business wasn't ready for DD really. We looked at putting together DD packs, and effectively the delay and us attempting to readjust the deal back into favour of the seller meant that one went on hold and didn't complete. Now that's a deal that will happen, and we're helping the business get ready for the transaction. But it just shows if you run with a cold approach and you don't have your numbers in the right place, it can be a very difficult deal. As opposed to Project W, it was a business operating in a regulated market, had a bit of IP with its product, got approached by a listed PLC. The offer received was for £9 million. First thing they did is pick up the phone, which was lovely. We looked at the deal and the underlying financials of the business. We thought it undervalued the business. We paused the deal. We reset it. So all the information they'd previously sent to that listed PLC, we kind of said, ignore all that. that was, our guys didn't know how to do a deal. We're going to reset these financials. We're going to prepare for diligence, and then we're going to send you a pack. And that's going to take us 6 weeks to do. So we completely reset the deal. We introduced a couple of other buyers into the process. We ran a full process, and the answer is there on the bottom there. We managed to drive the deal value up from 9 to 13. And actually that deal completion from heads to completion was 6 weeks. It was a very quick process. So it was a really good example of how, when someone approaches you, how to run a process to maximize your sale proceeds. Second example, just really around preparation. There's a kind of theme here about preparation. So on the left-hand side, Project B, it's a financial services business. It was a digital disruptor into that market where a lot of paper-based activity, really high growth. The business had outstripped its MI provision, really. Private equity, super interested in it. I'm really, really excited by the opportunity. But private equity, they do intensive diligence. So we ended up helping that business get the deal done. There was goodwill on both sides to get the deal done, and it got done. The fundamentals were there, but there was a lot of emotions and renegotiations and wobbles along the way because of the inability to provide good information and the lack of preparation for the transaction. As opposed to the other side, Project V is an automotive business. I'd say cookie cutter rollout. They basically had a number of sites that they could replicate. They knew how to do that. It was basically being driven by one of their suppliers. They could roll out. They had 10 sites. They could roll out. So they had 20 sites. They could roll out to another 10 in 12 months. Another 12 months after that, driven by their main supplier, main customer. Apologies. That one we did a full data pack and vendor due diligence. So we really prepared heavily for it. We set out for the buyers the potential profit of the business in 12 months' time with the sites that they already had identified and had got planning permission on. So we were able to really drive a hard process in terms of the structuring profit that they bid on. The vendor due diligence pack was absolutely fundamental to that process. We got buyers interested in it. We had 2 good bidders for the business. We gave both businesses that vendor due diligence pack. They were able to bid off the back of it. So that vendor due diligence pack contained all the information any buyer would need from a financial perspective or on the business, with an opinion from a third party, independent party, that they could rely on. And so we were able to then drive that process through in 6 weeks from third bidder. And what was really pleasing about that deal was that there were no adjustments between offer and final price. So it was a great deal for the shareholders. So both completed. One just had more headaches and wobbles than the other one. So MI and data, so management information, I think, a bit of it is preparation, but a bit of it's quality. So both these businesses were pre-audit. So I think my assurance colleagues, if you go and listen to their webinar, talked about how the audit threshold is changing. These guys were underneath the audit threshold in terms of net assets and profit. On the left-hand side, Project N, it was, again, a financial services business, insurance sector. It was a well-known advisor, top 20 accountancy firm, done very little to prepare. The deal, our clients, who were private equity-backed business, put an offer into N on the back of a 2-page document. When we went in to do the diligence on that, we found that the MI just didn't support what was in that 2-page document, and we were straight into having to discuss valuation and renegotiating that deal. The vendor, unsurprisingly, just sort of put his hands up and went, whoa, I didn't realise this. I didn't get told that, what was going to happen during this process. The deal's been put on hold, and we don't know when that might come back to market. As opposed to on the other side, I say successful deal, but there was no successful deal here. Really good, interesting story. This was a business. It was a B2C business, again, pre-audit threshold. They were looking to do a transaction. They'd had some interest from private equity. We went into that business and we helped them with their data analytics. So again, we've talked about that in previous sessions about preparing the business using data analytics. to maximise the opportunity, the value, and also the quality of the data that you can give employees, not employees, the quality of data that you can give to investors or purchasers. In this example, the information flow that they got from the data analytics was so good that they were able to point to areas in their business where they could just spend more time increasing the profit of their business before they went into the markets to raise money to help them grow. And our guys decided that they would just delay a process. And it's a great example of business preparation isn't just about hygiene factors. You should be using that time to maximize the potential outcome. And I think that'll be a great transaction, hopefully, that we'll be doing in 2024-25. Won't spend too much time on this slide. I mean, you've probably seen these themes before from us. We'll just say that I think from a housekeeping perspective, there are some changes coming up in the audit threshold I mentioned earlier. Be aware of that, particularly in where you're looking to raise finance and the impact that might have on forecasts. So one of the proposed changes in IFRS 102 is that operating leases are treated like finance leases. Now that has a clear impact on profit and balance sheets. So just be aware that if you're doing forecasts now, you probably want to build that into your thinking, and also to educate your investors or bank, if you've got bank loans, to get yourself kind of ready for a transaction and to educate those people so they're ready for the change. We often talk about talking to your legal advisor and making sure that everything is straight in terms of contracts. So whether that's environmental, staff, property, etc. Personally, we've had a couple of deals where they've been delayed at the end by 4 to 6 weeks because of customer contracts not being signed or being renegotiated. Now, sometimes that might be unavoidable, but to have it twice in the space of a few months is sort of bone of contention for me. Just points to making sure everything is in order when you go, because that's 4 to 6 weeks. Going back to the time conundrum, that 4 to 6 weeks, something could happen. And if that something happens, a deal could be lost because of something that could have been put right before you got to that point. We're seeing a lot of questions around tax, extracting property, particularly business owners not really understanding that acquirers normally aren't that interested in the property, and then the valuation of that property not being pound for pound for what their expectations of it are. So thinking about where you put your property before you do a transaction. Deferred tax, again, coming up a lot in terms of, is it debt, is it working capital? And again, the preparation piece around that to prime a buyer on how it should be treated rather than letting them tell you how it should be treated. Enterprise to equity value, I mean, that's a kind of 20-minute subject on its own. The point here is preparation. Tell the investor or the buyer how it's going to be treated and let them argue, rather than the other way around, which is let them form a view and then you're on the back foot. And then finally, just around approvals, just some tactics around trying to get deals over the finishing line. So quite often there may be some competition. We've got the National Security Infrastructure Act, we've got CQC, kind of bodies where you need approval to do transactions. And you need to be careful that you don't get to the end of the transaction and then that approval is just sat there waiting and the deal is contingent on getting that approval. You need to have the tactics right. So in most examples, you want to be exchanging subject to the approval of those bodies, whichever one's relevant. So nothing else, can impact the deal completing. Final point, change of control provisions, always a big thing for a buyer to make sure that key customers will still be there after the deal's done. So just again, to think about how to deal with that and how early to have those discussions so they don't become sort of a big mountain to climb when you're edging towards completion. Last slide, you might have had plan A, which is sell the business, get PE investment, etc. Again, all good transactions have a plan B or a plan C or a plan D. Project S was a B2C business. Before going to market, the vendor realised that the management team needed to step up So he spent 12 months coaching the management team, getting external coaching and giving them the titles and roles and stepping back from the business. In this example, he tested the market on a trade sale, and the kind of level of cash on day one wasn't where he wanted it. So it was very easy for him to be able to flick into a different transaction because it was a good business. And that one's now going down an MBO. So while you may have all your, you're investing in a particular route, there are lots of other alternatives to realizing investment, realizing shares or getting investment. So to conclude, summary, transaction market, there's definitely headwinds, but it's open. Would say, the theme of this is preparation is critical. Make sure you're ready for a transaction, because in the current market, delay can be the death of a deal. We started with the debt markets; they're definitely open. Alternative finance is here to stay. It is really plugging the gap, and there's a wealth of funds out there. I think our debt advisory guys, I was on a call with them yesterday. They talked to over 250 funders. It gives you a view of what's out there and the kind of flexibility that you can get with cost. And finally, despite what you might hear in the papers, there's lots of opportunities out there, and just encourage you to make the most of those. Thank you for your time.